Thanks for joining us here at xtime.com for the weekly outlook. I'm Christina Marujos, and joining me today is the lead investment analyst, Rafi Boyadjian. We'll be having a look at the upcoming week. Of course, Rafi, markets are still reeling from the hawkish Fed earlier this week, so it looks like the upcoming week also has a lot in store for us. So let's start by having a look at the United States. The dollar, of course, got a boost by the Fed meeting, and markets now are anxious to see whether the PCE inflation numbers for May will reinforce the Fed's narrative that any inflation episode will be transitory, and whether this will be another piece in the puzzle to bring forward the Fed's rate hike projections. Therefore, what are we likely to see in the numbers, and can the dollar be boosted even further?
Well, Christina, as you said, we had a huge reaction to the Fed decision. So all the more focus now on the PCE inflation. Of course, we already had the consumer price index that jumped to 5% in May. But the core PCE is the measure that the Fed prefers to look at as far as targeting inflation is concerned. So for the month of May, we are expecting a year-on-year rise to around 3.5%, perhaps even higher. So if you were to get something closer to 4%, for example, that would certainly get the market's attention. Now we know that there's a lot of transitory factors that are pushing prices higher, and such as supply constraints and so on. And in addition to that, we have, of course, the boost from the fiscal stimulus, the pent-up demand that's been built up from the lockdowns. So all of that is distorting the data. But nevertheless, there's a lot of it being driven by spending and consumption, and so the personal spending and consumption numbers that will be accompanying the PCE inflation numbers will be watched very closely by the Fed as well. Now we're going to have a batch of other data coming up as well in the US. We've got durable goods orders and existing and new home sales. So overall, if you were to get much stronger than expected data, of course, that could further boost the US dollar. But the bigger question is, what would it happen to Treasury yields? Because although we saw a big jump in Treasury yields, particularly the 10-year yield after the Fed, it has now reversed back down after the Fed meeting. So it's pretty much wiped out the gains post the Fed. So while it's true that there could be some idiosyncratic factors pulling yields that were actually pulling yields down prior to the Fed, and now we've gone back to that trend, it might not. So that means that we might not be getting an accurate picture of what the markets think all about the Fed policy outlook, but the dollar's rebound could become questionable if yields continue going in the opposite direction. And so there's going to be a bit of focus, not just on the dollar next week from the data, but on Treasury yields as well.
Looks like it's going to be a very interesting upcoming week. And now crossing into the United Kingdom, it's going to have a busy week as well, because we're getting Flash PMI readings on Wednesday, followed, of course, by the Bank of England policy meeting on Thursday. Now, even though no change in policy is expected, could a surprise PMI print maybe change the BoE's policymaker stance?
Well, we've already seen the reopening of the UK economy boost the PMIs in April and May. So there's probably going to be further boost for the month of June, though we might get slightly softer numbers for June compared to May as the lifting of the lockdown effect fades somewhat. But on the whole, most of the good news on the economy is already priced in the pound right now. So if you were to, perhaps an even better than expected set of PMIs might not do much in lifting the pound. So at the moment, it's the Fed policy that's really driving all the dollar crosses, including cable. So the pound's outlook doesn't just depend on the Fed; it also depends on the Bank of England. So although we're not expecting any policy changes this Thursday from the Bank of England, because they're probably going to wait until their August meeting to decide if they should further slow down their asset purchases. We might see some tweaks in the language in their statement. We had very recently a very strong CPI data out of the UK, and the other data overall such as the recent GDP prints, as well as, of course, the PMIs have been fairly solid. So we know the recovery is going as planned. So if we see reference to these data, particularly inflation, in the statement, that could suggest that further tapering is likely at the August meeting. But the real signals, of course, will probably come in August. So until then, we might not get, the pound is unlikely to benefit a whole deal from anything else.
It looks like August is going to be a crucial month for markets. Now, finally, let's have a look at the euro, which of course took a hit from the hawkish Fed earlier this week. Of course, we're expecting PMIs for June out of the Eurozone this upcoming week. Therefore, can they provide the single currency some support?
Well, we saw the euro fall quite dramatically after the Fed, and so positive data, we could see it spark a bit of an upside correction, at least in the short term. In the bigger picture, though, the euro's outlook is notably weaker after the FOMC meeting, because it's looking almost certain that the Fed will exit its stimulus programs before the ECB. And only last week we saw the ECB actually sounding more dovish, whereas now the Fed has turned more hawkish. So there's clearly a big policy divergence happening between the two central banks, and that's likely going to weigh on the euro for a while longer. So although we're seeing good progress on vaccinations in the Eurozone, and the data is supportive of the narrative that the Eurozone recovery is strengthening, so all of that should prop up the euro. But until the ECB joins the Fed in signaling some dialing down, some dialing back of its stimulus, the euro will probably struggle.
Rafi, thank you very much for joining me today. This was the Weekly Outlook here at exam.com.